Hello, my name is Piyush Mittal, and on behalf of Burke & Rhodes Reports and our group of analysts comprised of Chanel Shen, Michael Epstein, Danielle Lee, and Pradeep Sudhana, I would like to welcome you to our Cyberonics company video. First of all, what does Cyberonics do? Cyberonics has invented and patented a vagus nerve stimulation therapy, otherwise known as VNS. VNS therapy has been used to treat drug-resistant epilepsy and even drug-resistant depression in some cases. In this therapy, a small generator is inserted into the chest area and a lead is connected to the vagus nerve. Electronic pulses are sent through the lead to the nerve. These currents help lessen the frequency of seizures, and some new devices stop a seizure from taking place. Cyberonics is located in Houston, Texas. They are vertically integrated and produce all components of the device, from the computer chips to the leads, in-house at their Texas facility. After multiple years of losses, the CEO, Daniel J. Moore, took office and renewed the company's focus on epilepsy after the company was unsuccessful at gaining in the depression market. The device is marketed and sold internationally in over 72 countries. The company's ticker symbol is CYBX and is traded on the NASDAQ stock exchange. As seen in the graph, the company's stock fell at the beginning of 2008, but has been recovering over the last 3 years and has recently been on an upward slope. In 2009, Cyberonics contracted with the Japanese firm Nihon Kohden to sell VNS therapy in Japan. Nihon Kohden is one of Japan's leading medical device companies, specializing in the manufacturing, development, and distribution of a variety of medical devices. More recently, the company was forced to pull their latest two products, the Aspire HC and SR generators, from the market, as they did not deliver a current as strong as the current originally programmed by the doctor. These problems were not harmful to patients and have been corrected. In Europe, the firm was forced to cancel the impending E36 trial for the treatment of treatment-resistant depression. Fixing this problem in the trial will be a major focus for Cyberonics in the short term, because the company is still planning on receiving regulatory approval by April 27, 2012. On October 5, 2011, Cyberonics announced that it has made an initial investment of $4 million in Imthera Medical Inc. Based in San Diego, California, Imthera Medical Inc. is developing an implantable neurostimulation device for obstructive sleep apnea. The investment is dependent on regulatory approval and clinical milestones and costs $12 million. Capital requirements are a major source of operating risk for Cyberonics. Costs such as research and development and post-marketing clinical trials are extremely expensive and generate considerable fixed costs. The high level of fixed costs result in high operating leverage that could prove troublesome if sales slump. Cyberonics is involved in a number of product liability lawsuits, which is not uncommon in the healthcare sector. Cyberonics carries product liability insurance in an amount it believes is reasonable to protect itself and cover possible damages. The company is located in a hurricane-prone area and has planned for this type of disaster by building up 3 months of additional inventory. Although the company was founded in 1987, the VNS therapy system did not gain FDA approval until 1997. The business was and is completely dependent on FDA regulations and policy. FDA approvals are granted by the Center for Devices and Radiological Health, a branch of the FDA. Receiving insurance coverage is an obstacle for those suffering from TRD and drug-resistant epilepsy. The company works with its patients on a case-by-case basis to explore payment options and insurance coverage. As with any company, a changing economic climate can pose various threats to Cyberonics. Interest rates are currently extremely low, which makes it easier to borrow. However, these low rates may affect the inflation rate and make certain costs rise. Due to the niche product that Cyberonics produces, the company does not have direct peers. However, there are a handful of companies that produce devices similar to Cyberonics. For our analysis, we used Arthrocar Corporation, ConMed Corporation, Great Batch Inc., and Beavis Inc. Among the statistics that stand out the most for Cyberonics is the company's ROE of 31.92%, which is way above the industry average of negative 5.5%. Cyberonics also enjoys a debt-to-equity ratio under 1%, well below the industry average of 34.55%. However, Cyberonics' EV to EBITDA multiple of 12.91 is quite high compared to the peer average of 2.14, indicating that the company may be overvalued. 92% of Cyberonics shares are held by institutions and mutual funds, and close to 172 institutions and 272 mutual funds are currently invested in Cyberonics. The top 10 institutions hold 52% of shares outstanding, and mutual funds own 49%. As of November 2, 2011, institutions sold off 46% of shares and bought 38% of all shares. making up most of a large part of Cyberonics' stock activity. Insiders hold just 3% of the shares. The company has a promising share repurchase program under which it expects to repurchase 1 million of its shares, a signal that it is performing well and can lower equity investment. In a similar share repurchase program, the company bought back 767,000 shares in 2010 and 515,000 shares in 2009. On Friday, October 14, 2011, we visited the Cyberonics facility in Houston, Texas. We were able to meet with Gregory Brown, the Chief Financial Officer, Dr. Milton Morris, the Vice President of Research and Development, and Victor Vazo, the Director of Epilepsy Marketing. We were then escorted into the production area by Hector Santana, the Senior Manager of Manufacturing, and given a tour of the facilities. The visit was extremely helpful in formulating a better vision of where the company would like to go and where it will focus its efforts. After a stint of investing many efforts into obtaining the TRD market, the new management reiterated that its main market is epilepsy patients, and that they are dedicated to the cause. Information like this is hard to pick up through outside research, and thus the visit clarified our assumptions and prior research. Cyberonics is a high-growth company. It boasts a healthy and strong financial position with a low debt-to-equity ratio, sufficient cash to fund its R&D operations, and strong financial management. During fiscal year 2010, Cyberonics continued its positive return for the third year in a row. For Q1 2012, its cash position was $81.6 million, and long-term debt was $6.5 million versus $7 million a year ago. With its management strategies and strong financial structures, Cyberonics will continue its steady growth, operating profitability, and increase shareholder value. Our valuation of Cyberonics leads us to a 12-month target price of $41. This was found by evaluating three methods: discounted cash flow, the price-to-earnings multiple, and the price-to-earnings-to-growth multiple. Although we use the three methods to value Cyberonics, because of the company's steady growth and niche market, we believe the DCF does a better job of capturing the fundamental value of this company. For the DCF, we assumed a high growth rate of 11% until 2016, when we assumed a more normalized growth rate of 5%, with a terminal growth rate of 2.5% after 2021. Our weighted average cost of capital was calculated to be 7.57%, based on assuming a risk-free rate of 2%, a market risk premium of 5.7%, and a beta of 0.97. Here is a summary of how we believe the stock price will perform in the next 12 months. The current price of the stock is $29.18. Our 12-month target price is $41. This implies a total return of 40.5% over the next year. Needless to say, we have given Cyberonics stock a market outperform rating.